right, welcome to the next webinar here for the Multifamily Investor Nation. I am your host today, Dan Handford. I'm actually one of the managing partners of a group called PassiveInvesting.com. You can see our website here on the screen. You can go to PassiveInvesting.com if you want to find out more information about us. But if you want to find out more information about me specifically, you can go to this Meet the Team section here. When you go to the Meet the Team, you'll see my pretty little face here. You can click on that, and there's a video on my bio page, as well as some information there so you can understand a little bit about who I am and where I come from. I am married, have 4 children, 3 girls and a boy, ages 10, 9, 4, and 3. And I live and work here in Columbia, South Carolina, for those of you who might be familiar with the Carolinas. So I'm located here right in the middle of South Carolina, and very happy to be here and excited to present to you today about this topic about apartment syndication. But one more thing I wanted to mention to you before we get started there is two things. One, if you're interested in investing with us, when you go to this website, there's this big blue button at the top right-hand corner that says Join the Passive Investor Club. You can click on that button there, and it'll allow you to be able to have a form that you can fill out. And once you fill that out and submit it, one of our team members will reach out to you to discuss your investment goals to see if our group's the right fit for you for some of the investments that we put together. You can also go to our current offerings, and you can see we have one offering available right now called Ascend Waterly. We also have a real estate debt fund. And then later this week, we'll actually be launching our self-storage fund. So you can stay tuned for that. But our Ascend Waterly deal is a multifamily investment offering. So you can click that, review some of the details on this investment offering itself. It is a fairly large deal. It's a $91.6 billion deal. We're in the process of raising $31.77 million. And oh, look at this. We're going to be talking about preferred returns today. And this particular investment has 2 types of preferred returns. It has a 9% preferred return for the Class A investors on the preferred equity side. And on the common equity side for Class B, it has a preferred return of 7%. So feel free to jump over there and do some research. This investment's only available for accredited investors. So if you are an accredited investor, you can fill out this form, and we'll be glad to send you some more information about this particular investment. Let me go ahead and go back over to our page for today. Today, we are going over this preferred returns. Now, preferred returns can be misunderstood in many different ways, which is one of the reasons why I wanted to talk about it today. But let's first, for those of you who might be on here and maybe you don't really understand, or maybe you don't even know what a preferred return is, let me just break that down for you pretty quickly here. And it's not a very hard thing to explain, but it's definitely something that you want to fully understand and before you actually decide to invest in an investment. So first off, a preferred return is a minimum return that you would receive from the operator before any of the share of cash flows or sale proceeds goes to the operator, right? So it's not necessarily the minimum investment, but it's the minimum return that you receive on an investment before the sponsor or the operator gets any share of the cash flows, okay? And it's typically expressed as a percentage of return on an annual basis. For example, if you invested $100,000 and the preferred return was, say, 7%, then you would receive about $7,000. That's $100,000 times the 7%. So $7,000 in annual return from the available cash flows off the asset before the operator got anything. So that would be your preferred return calculation there. Now, the preferred return is very vital to you, especially as a passive investor. But for those of you who are kind of wanting to be active in the space and doing your own syndication deals, it's important for you to understand these various nuances and how they impact the investor themselves and how they actually think. Because and I know Ray is on here asking about the slides are not showing. I don't have any slides for this, so don't be thinking about slides. Just kind of listen in and pay attention to the content that I'm sharing with you today, so you can actually hear and understand what we're going through. I know people ask me that all the time about slides. We don't actually have slides, so just kind of follow along. And if you have some questions, then feel free to jump in and ask any questions. I'd be glad to be able to do that for you as well. I'll go ahead and stop this as well, because you don't necessarily need to have that screen shared, if you will, while I'm talking. most of you know what's going to be covered for today, and I'll keep it up on my screen so I can be paying attention to it as well. So the preferred return is vital for you as a passive investor, because when you're investing in multifamily assets, it allows for you to have better alignment of interest between you and the operator. This is because that internal rate of return is one of the main metrics that is used to evaluate the performance of an investment. And the operator will pretty much be focused on what's called the time value of money to reduce the overall lifespan of the investment to increase your overall return. And the main reason for an operator maybe that doesn't offer a preferred return is that maybe they are not very well capitalized and they don't want to delay their splits before the investors get their splits. And so if they're not offering a preferred return, it usually means that that group is not well capitalized and they need the funds to be able to live off of in order to put food on their table or pay their bills or whatever, right? But most groups nowadays will offer a preferred return, especially if they're a solid, legitimate type of an investment group. And our group does it as well. So at passiveinvesting.com, we always offer a preferred return, and it's different based on the deals. But typically right now we're putting together deals that are usually anywhere between 7 to 9% preferred return. So again, that preferred return is where 100% of all the cash flows goes to you as the investor before it is split between the actual the GP or the operator, right, or the sponsor, however you want to say however you want to say it, right? I usually just use the word operator, right? Because everybody kind of understands what that means. There's the general partners, which is the operator, and then there's the passive investors, which are the LPs or the limited partners in these types of investments. And so those preferred returns protect the investors. And at the end of the day, one of the main reasons why we do preferred returns is because we want to make sure that we're protecting our investors' downside, right? And we want to make sure that we want to make sure of that because number one, our group we are investing alongside our investors on every single one of our assets. So we're an investor too, right? We're an investor and a limited partner first, but at the same time, our group is not looking to put together just one deal and walk away, right? You know, I've been in this business several years now, and I've seen several people that have started a syndication business, put together one, maybe two deals, and then you never hear from them again, right? Those are not the type of people that you want to invest with. You want to be investing with a group that you know is going to be there for the long haul, and you want to make sure that they're investing alongside you in each one of the investments, and you want to make sure that they are growing their wealth alongside your wealth at the same time. And the only way to do that is to set up your investors for success. And one of those things that's an easy way to do it is the preferred return, right? So that basically it's not a guaranteed return, but it's a preferential treatment of the cash flows and the sale proceeds. And there's a couple of different nuances to them. So there is what's called a cumulative preferred return and then a non-cumulative preferred return. And so a non-cumulative preferred return is a preferred return where, let's just say it was that same example we said earlier at 7%, there is that 7% preferred return. But if for some reason, let's just say the first year, you don't hit that preferred return with the cash flows, let's say it's at 5%, and a non-cumulative preferred return, the next year, the preferred return just resets back to where the preferred return is at 7%. Right? So you lose that 2% from the first year. However, there's also what's called a cumulative preferred return. That's where if you lose the preferred return or not lose it, but you miss the preferred return mark for the first year, and let's say it's at 5%, then the second year, the preferred return actually is added on from what was missed from the first year. So if you missed by 2 percentage points, then your 7% for year two now goes to 9%. And so now year two, there's a 9% preferred return. And so before any splits with the operator, you have to achieve that 9%. Now, that is exactly what I look for when I'm placing my own passive capital. My wife and I, outside of just investing with our passiveinvesting.com group, we also invest in other offerings. And right now we're invested in 52 different LP positions in various multifamily as well as self-storage assets with about 15 different operators around the country. And one of the things that we look for are those cumulative preferred returns. And that's very important because a lot of times you won't actually notice whether or not it is a preferred return that's cumulative or non-cumulative until you review and read in detail the private placement memorandum. One of the very first things that I look for when I'm reviewing a PPM is what happens during distributions. And there are three different types of distributions. There's distributions of the cash flows, which are cash flows that are generated during the hold period. Then there are the distributions from a capital event that would be maybe a refinance or a supplemental loan that would maybe be in the middle of the hold period. And then when you go full cycle and you sell the asset, there's that third distribution, which would be distributions from the sale promote or from the sale, right, of the asset. And so those are the three different types of distribution and waterfalls that I look for inside of the private placement memorandums that are issued whenever you tell an operator, hey, I'm interested in investing. Those are the things you want to look for is it cumulative or is it non-cumulative? Stay away from the non-cumulatives. And when you're putting together your own deals, always do a cumulative preferred return. So those are definitely things you want to make sure you look for. Now, there's also what is called a true preferred return or a preferred return with what's called an operator catch-up. So let me explain both of those. A true preferred return is what is actually where you have, again, 100% of the cash flows up to that preferred return amount are given to the limited partners, the passive investors. And then after that percentage is achieved, then you have the equity split. So for example, let's just say you have a 70-30 split. After that preferred return, 70% going to the investors, the passive investors, and then 30% going to at the operator. Well, that's what's called a true preferred return, where 100% of the cash flows up to that percentage point goes to the investors, and then after that it's split 70-30, right? Now there might be a secondary hurdle within the waterfall where the equity splits change once the investors receive a certain return metric. But that's not the topic for today, but that's kind of how that would work, right? Now, the other thing that you have to be careful about and watch out for is that preferred return with an operator catch-up. And what this does is what happens is the investor gets 100% of the cash flows up to that preferred return amount. So let's just say the 7%. But before the equity gets split, before the investors get anything else, the operator actually gets caught up as if they were getting 70-30 all the way up to the point of getting that 7%. And so that's what it's called, a operator catch-up with the preferred returns. And you have to be very careful when you're reviewing these offering memorandums or these private placement memorandums, because it'll be kind of nuanced in there about how these things are displayed. But it's in my opinion that if you have if an operator has a preferred return with an operator catch-up, the deal is way too rich, if you will, for it, which means that the operator is getting a lot of return before the investor does, and you're not aligning your interest with the investors as much as you need to, from the operator perspective. And the reason why that is because most deals, especially right now in the current market, are hard to pencil, even without the operator catch-up. And what you'll find is that a deal that has an operator catch-up must include a refinance inside of the underwriting. And so it's my opinion that you should never invest in a deal that underwrites for a refinance. Now, that does not mean that I don't like the refinance idea. It's a great idea and we still want to do it, but I would rather it be the cherry on top of what we are presenting to our investors and not what makes the deal actually move forward and actually work. And if you see a deal and you're reviewing the offering documents and you see this preferred return with the operator catch-up, with this kind of what is called a pari passu type of preferred return, then usually you're going to see something like a refinance being underwritten in the deal. And unless you ask about it, because I've reviewed documents before, they never mentioned anything about the refinance being included in the underwriting, but their fees were really high, and they included this operator catch-up. And the operator catch-up is what caught my eye. And I sent a message to the operator and said, "Hey, are you doing a refinance in this deal?" And they, every single time I've asked that, they've said yes. And so I back out. I don't do the deal with them because it's too risky for you as the investor to invest in a deal that has a refinance modeled into it. And the reason why is because you never know when that refinance is actually going to occur. There could be things that come up that delay renovations and delay that increase in the NOI that allows you to get the cash flow or the cash that you need off the refinance. And you don't know what your loan to value is going to be. You could guess, but you never know until you get that at that current time, 2 or 3 years down the road, to know what that refinance is going to be. And you also don't know what the interest rate is going to be, years down the road. You don't know what the cap rates are going to be looking like at that time. So you really have no idea. It's like a shot in the dark in order to determine what kind of proceeds you're going to get from a refinance. So it's my opinion that you should not underwrite for a refinance in your models and in your underwriting, because it could really affect the outcomes for your investors. And as a passive investor, stay away from any of those deals. And again, back to the preferred returns, most deals that have this preferred return with operator catch-up, it's usually because they have a refinance. They need the refinance in order to make the deal work, because the operator catch-up is too expensive without it. So always be looking for deals that have a true preferred return, where 100% of the cash flows go to the investors, and then straight from there is the split 70-30 from that point forward. That is really what you want to look at. Now, when we talk about these preferred returns, we're not talking about preferred equity. So there's a difference between preferred return and preferred equity, right? And in preferred return, this return is related to receiving a priority treatment as it relates to your return on your initial capital invested. Now, in preferred equity, you would be in a preferential treatment position or a priority position in the capital stack closer to the debt to receive your returns during the hold period, right? And in a priority position to receive your initial capital back first when the asset is sold. And this is important too, for those of you who are maybe looking at putting yourself in a preferred equity position. Make sure when you're reviewing those documents that you have preferential treatment, not only in the cash flow distributions, but also in getting your initial capital back before the common equity people or the common equity investors. That's why you get a lower return, because you're going to get a higher preferred return, but a lower return overall, because you're giving up that risk profile. You're in a lower risk position because you're going to get a higher likelihood of getting your return, because you're in a lower position in the capital stack. So, and again, there's also some confusions as to how capital stacks are built. But if you've ever built Legos before, and I know we all have, right, as kids, you don't build Legos from the top down, right? It just doesn't happen that way. Gravity is from the bottom up, right? So you build a capital stack or stack from the bottom up. So at the bottom of the capital stack is your debt, and then you have your preferred equity, and then you have your common equity on top of that. So you want to be as low in the capital stack as possible to be as close to that debt position. And of course, the debt position is the lowest risk, so where they get the lowest return. And then right next to that is that preferred equity slice. And you really don't want to be in a position where that's any more than about 35 on the top end, maybe 40%, 35 to 40% of the capital stack being in that preferred equity position. Otherwise, the risks just continue to go up, and you're losing that risk benefit ratio of being in a lower risk position in the capital stack with the preferred equity position. All right. So the last thing I wanted to mention to you is understanding how these preferred returns are calculated. And it's just really important for you to understand this, because it'll affect your returns as you're reviewing which offerings to put your money in. So when it comes to preferred returns, the way preferred returns are calculated are on what's called the unreturned capital contributions. Now, what that means is let's just say you invested $100,000 into an investment, and over time, your investment is paying you back cash flow distributions, right? You're getting what's called a return on your capital. So your initial capital is staying the same. It's $100,000. But let's say that there's a refinance event and you get 50% of your capital back. Well, now your unreturned capital contribution would be going down to say $50,000. So now your preferred return is calculated off of $50,000 and not the initial $100,000 investment. And the reason why this is important to understand is because there are also operators that will do distributions like cash flow distributions that are monthly or quarterly, and they'll distribute them on what is called return of your capital, which means every time you receive a distribution, you're getting a return of your capital, which is reducing that unreturned capital contribution. So the preferred return is actually going down. The only thing the only person that benefits is the operator. It doesn't benefit you at all. They'll try to tell you that it's better for you from a tax perspective because instead of getting the return and having to pay a tax on your return, you are now getting your capital back so you don't have to pay taxes. That's baloney, malarkey, bukkake, whatever you want to call it, right? It's BS. So don't listen to that at all, because when it comes to cash flows, if I'm getting cash flows off my investment, let's say I'm getting, say, $7,000 a year, that's 7% return off my money, and it's calculated as a return on your capital. Yes, you're going to be taxed on that. However, the depreciation offsets that tax on the asset, and you essentially are deferring that down the road, right? And at the end of the day, when you sell the asset, it's a wash anyway, either way you slice it, because your basis in the property is continually going down, whether you are doing a return of capital or you're doing a return on your capital with the depreciation benefit as well. It's the same thing. The only thing and the only person that benefits by doing that return of capital on distributions is the operator. So absolutely write that down and stay away from operators that do return of your capital on distributions. You should always look at these private placement memorandums and review the documents carefully and make sure that you only invest in offerings that do distributions, the cash flow distributions, on what's called a return on your capital, right? And that way your unreturned capital contribution stays high and stays at the level that you want it to, unless there is a capital event like a refinance or, of course, when you sell the asset. But that's important to understand how those preferred returns are calculated. It's based off of the unreturned capital contributions. And it's very important to understand that as you are placing your passive capital into various investments. And also for those of you who are structuring your own deals, make sure that you are protecting your investors and you give them those distributions as return on their capital. All right, so I've gone for about probably 25, 30 minutes now, and I want to open it up for any questions that you may have for me. And I'll spend about maybe 5 or 10 more minutes going over some of those questions for you. And then I'll let you know what the topic's going to be for the webinar for next week. So go ahead and start typing in some of those questions. There's a few of you that have already done that. So we'll answer some of those questions as they come in. All right, so first question that has come in here is preferred interest on your investment or return of investment. Sounds like the first. And it's not necessarily interest, right? So I mean, it depends on the investment, but in these types of multifamily syndications, it's not an interest return. It's an investment return, right? So it's actually a return. And I know it's a little bit of a nuance there or whatever, but it's a preferred return on your investment, right? So it's not a return of your investment, it's a return on your investment, which again, it's really kind of pointless when people are doing doing a return of capital, because they're not even getting a return on their capital at all. It's just giving them back their initial capital, which again makes no sense to me. It only benefits the operator, which again, stay away from those groups. It's also a group that'll likely have a refinance in their underwriting, and they'll have a GP operator catch up with their preferred returns as well. Does the sponsor still get the asset management fee if the preferred returns are not met for that month? So this is a good point here to bring up, because most operators will still, well, I won't say most many operators will still take the asset management fee, even if they're not making distributions. Okay. So it's not necessarily that they're hitting the preferred return. It's that are they making the distributions as projected, right? So for example, we have a deal right now, this Ascend Waterly deal. The first year, I believe the cash flows are a little bit light. It's about 5% or so, like 5.1 or something like that. So around 5% return. Well, we're still taking our asset management fee to be able to manage that asset, even though we're not hitting the preferred return, which is 7% for the Class B investors. However, if for some reason the property starts to not perform as projected and the returns start to go below and we have to withhold distributions from investors, then we stop taking our asset management fee. And it's because we don't feel like if we're not doing what we originally projected to the investors, then we shouldn't be taking the asset management fee, right? So yes, that's a great question, great thing to bring up. And I have been in investments where they continue to take that asset management fee, even when they're not paying the investors. And I would say, again, ask those questions up front to the operators as to how they protect you as the investor. I don't feel like especially with our group, that we should continue to get paid an asset management fee if the property is not performing. Why should we continue to take off more cash from the property when the asset is not even performing to be able to pay the investors? So definitely when you're setting up your own investor relations process, definitely be thinking about that and understanding how can I set myself up to protect my investors so that they want to continue to invest with me over and over. Our group, the last several deals that we've done, we have over a 61 to 62% repeat investor rate, which means the same investors are investing over and over and over again in our investment and in the offerings that we put together. And the only way that's going to happen is to make sure that we are setting up ourselves and our investors, making sure we're setting up our investors for success and protecting them. And that's all we're talking about today is just protecting and setting up your investors for success. If you have outside preferred equity company involved, how does it affect the single preferred return investor? Where does everyone stand in the capital stack? So typically, if you have an outside group that is bringing a large amount of capital to the deal, then they are going to be usually at the bottom of the capital stack next to the debt. So it'll be the debt, it'll be the preferred outside equity group. Then if you have another preferred equity position that's inside the group, you'll have that. And then on top of that would be the common equity, which would be your Class B investors. But a lot of times what you'll see is that instead of having kind of two preferred equity positions, you'll just have one, you'll have the debt, you'll have one preferred equity outside group that will bring in a large amount of capital. And then on top of that will be your investors, which might even be in a Class A position, single share, typical, 7% pref with 70-30 split after that. The biggest thing to be watch out for with the preferred equity groups that are bringing large checks is that they want to usually see a track record. So they want to make sure that you can actually perform on the asset. And then number two, they're going to want to have take back clauses. And they're going to also usually have reporting requirements and maybe some asset management requirements for you on your investment there. Our preferred returns, or this is saying, preferred returns are tax-free. Will this change under Biden? So Biden hasn't necessarily, at least not from what I'm familiar with, has not necessarily started to attack the depreciation benefits, right? And obviously there's the bonus depreciation that's going to eventually be phased out over the next few years. But when it comes to Biden right now, the only thing that he's really kind of going after is potentially the 1031 exchange, right? The 1031 exchange rules. And so if there's a certain amount of 1031 exchange, then he's going after limiting that amount of the 1031 exchange. I am of the opinion that that's not going to fly very well because just about everybody in Congress is benefiting in some form or fashion with 1031 rules. And for them to go in there and say, no, we're going to do away with it, I think they're going to have a hard time doing that. But when it comes to the preferred returns, they're not necessarily tax-free. You are basically just deferring the tax, right, with the depreciation. Because if you cash flow, say $7,000 in the first year, and you get a $10,000 or $15,000 or $40,000 or $50,000 depreciation benefit, that can actually offset those cash flows you receive that year, and then you can carry those over for future years as well to be able to continue to offset some future cash flows off of the asset. And so you should typically, if you're holding those assets for 3 to 5 to maybe 7 years, you should have enough depreciation to be able to offset the majority of those cash flows and not necessarily make them tax-free, but you're deferring the taxes to a future date. So you're basically reducing your basis in the property. So when you sell the asset, then you're going to have a difference. You're going to have a capital gains tax that you'd be hit with unless you do a 1031 exchange and you move that investment into another asset. Another question in here is, how does a refinance or a supplemental loan affect your basis? So it doesn't necessarily affect, so it would actually reduce it should reduce your basis based on the amount that you actually receive. So if you initially invested $100,000 and your investment gave you a 50% return of your capital on a refinance, then your basis would go down by that amount. Now, you don't pay tax on the borrowed money either. So it's reducing your basis, which means you've already received that capital back. So when you sell the asset, you would pay the capital gains on the difference there, right? So you have to make sure that you watch that, because it does affect what your basis actually is in the property. Let me see here. I have one more question that's coming in here, and then I'll go ahead and finish up for today. Another question here is, what books would you recommend for those of us who want to go deeper on this topic? The unfortunate thing is there's not really a lot of books specifically about preferred returns that go deep into this particular topic. However, our group is actually writing a book right now. It won't actually be published until January of 2022, but we are in the process right now of finishing up writing a book on the apartment syndication business as a whole, everything from A to Z. And one of the topics will be this preferred return topic, and we will be talking about it in that book. So stay tuned for the future. We will have that book released in Q1, likely, or shooting for January of 2022. So thank you there for that. All right, so I have no other questions that have come in. I am going to share my screen real quick. There is another topic for next week. Let me see here. Let me see if I can do this again. There we go. So the next topic for next week is closing your first apartment syndication deal. And this is going to be with our other managing partner, Danny Randazzo. For those of you who have been following us, you've probably heard from him before, but he's going to be talking about having strict criteria, having strict criteria that yields better results, timing of closing steps, what, who, when, and of course, a lot more details within that as well. So make sure you stay tuned for that. In the chat box, we'll go ahead and type in the link for you to register for this next webinar, so you can register for the next week's webinar and be a part of that. We'll also send out this video as a recording so you can review it. And then also, don't forget, go to mfinsummit.com and register to lock in your pricing right now for the MFIN Summit coming up in January 2022. So thank you so much for being here. Thank you so much for participating, and look forward to seeing you back here next week for the next webinar in the series for the Multifamily Investor Nation.